Let's dive in to our next session, Shaping the Future of Investments, Industry Insights, and Career Strategies. To moderate this session, it's my pleasure to invite Ms. Rajni Dhameja, CFA. Rajni is a co-chair of the Career Service Committee of the CFA Society India and Zonal Head, ICICI Bank. She has been associated with fixed income markets since last 11 years in one of the largest private bank covering origination, structuring, valuations, and market risk management. With overall experience of around 19 years, she was associated with the equity and equity derivatives market in her previous stint into quantitative analytics space with stock exchange. Welcome, Rajni.
Thank you, Deepika. Thank you, Nidhi. Good morning, everyone. So, a bit of introduction about Dr. Aaron Lowe. Dr. Aaron Lowe, CFA, he's currently CEO of LUMIQ, an investment technology firm, and he's a vice chair of CFA Institute Research Foundation. Over his illustrious career, spanning across 2 decades, he has spearheaded the various asset allocation, equity, and credit strategies. He has been associated with the major firms like PIMCO, Allianz, etc. And he has chaired the board of governors of CFA Institute. Friends, today we are really privileged to have him here and get some practical insights from his career, which we can actually apply while we maneuver the career. And we understand that, this could be a complex task. Getting the wisdom from the people who have been there and who have done that, it's really a good investment which you people will be making on a Saturday morning. Welcome, Dr. Aaron.
So I kind of set up, I wanted to kind of think about what to say today, and obviously the idea was to give an opening remark and maybe some guidance to what you think your career is going to be. So I had to kind of recollection of what I went through and how if I were you, I might be laying out my options. But certainly I want to kind of stress to you that there's definitely a very exciting period in front of you. But these exciting periods may not be sustainable, and we're going to see what I've gone through, and maybe that will help some of you to navigate what you will likely to go through. So investment management that you've chosen to be in is definitely one of the key pillars of society. I think the idea, when I grew up, I started off in engineering, I started off in physics, and my first work was in IBM. I didn't know anything about finance. But in the second year, I switched to finance because there was a project that kind of motivated me to kind of enter the world of finance. And I've never looked back since, right? And I realized that in Asia, most of the young were kind of aspired to be engineers and technologists. And finance was not always the front runner. And that's typically the case for all of East Asia. And when engineering and industry grew up, you create wealth, and you definitely need a good financial ecosystem to manage that wealth. And so these things kind of work quite closely together. And this is, I think, the time where you can see that growth in the area of finance. So I think this is a good spot for India especially. Maybe I just can talk a little bit later about my experiences in the Japan cycle, the East Asian cycle, the East Asian tigers, the Chinese cycle, and this could be the Indian cycle. So those are the past 3 decades of ups and downs, and some of the learning points in some of these markets here. So certainly this is potentially the time for India's expansion. Certainly the market seems to be pretty bullish on this, but I'd like to kind of give you a sense of where we see things in a global context. So certainly the growth of asset management, the ecosystem, private banks, financial advisors, investment bankers. They're part of the entire ecosystem, which I think all of you have a role in. And I wanted to kind of think about at least the global landscape of what we're going through, because every cycle is slightly different. And this cycle, the elephant in the room is obviously AI. I'm sure most of you kind of have an example, some experience in AI. And it's going to change, I think, everything we know. Okay, and we still do not know what it is capable of at this point. So obviously, everything else is going on, the role of retail investors, because, if I were to think about the last 30 years, retail investors were edged out in developed markets, and the reason was because they were playing a losing game. And the reason why they're playing a losing game is institutional investors were equipped with everything you can think about in managing markets. They were doing 24/7, they have huge support systems, they have huge networks, they have huge everything in terms of what it needs to be successful in trading and analysis and portfolio management. And retail guys were just tourists in the investment trade. I mean, they are going in when there's a hype and they kind of get out at the top, at the bottom. And they were kind of losing that alpha, and they gave the alpha to the institution. So for example, institutional investors like us, we love retail because, they're the ones that we are getting the alpha from. So the retail guys were not stupid. After a while, they realized that, they're not making money off trading, and they just hand it over to funds and ETFs, right? So that's the reason, one of the reasons why in the US and in developed markets, you see the active funds don't give much alpha. There is some alpha, only 30% of the funds have alphas. And so then there was this demise in the volume of retail. Then came Robinhood, then came a lot of these other technology that has helped retail investors to come back again. But retail investors don't really try to do the alpha. They do more or less the beta allocation. So the game has changed a little bit. So instead of choosing a single stock, I would choose different ETFs. And so the activism has moved from the alpha selection to beta allocation. The game has changed. Obviously, people do that alpha selection as well. Every time you see a NVIDIA and every time you see, a singular stock, you punt on that too. But I think that investment game has changed somewhat. So that gives us the next section, which is customization and direct indexing. This is something that's very popular in the US. For the last 2 years, JP Morgan, Goldman Sachs have invested billions in this market, and we monitor it very closely. European market is actually catching on. Usually things that happens in the West, it takes about 10 years before they come to Asia. So for example, in robo-advisors, I was at PIMCO, and my technology team was working for Charles Schwab for the very first robo. And that was in the year 1999, 2001. It was 8 years before Betterment, which was the world's leading robo-advisor. And robo-advisors didn't come to Asia until maybe about 6-7 years ago. So you can see how late that adoption rate is. And maybe for good reason, because maybe the level of sophistication in the market was not ready. But I think these cycles are getting a lot more compressed. People are learning a lot more because of all, the tools that we have right now. So keep an eye for that. Direct indexing is when everybody can have your own ETF, right? Your own choice. You can customize it no matter what way you want it to be. So I think that's going to be something that's interesting to look out for. Decentralized finance, I mean, you guys do, I know, crypto assets. That's something that is quietly making its rounds, especially in the financial system, because of the new advances in everything that is in the blockchain space. Obviously, everyone doesn't want to talk too much about it, which for good reason, because the swings are pretty wild. And I've seen a lot of people got hurt by some of these forays into, especially if you're going to be a crypto tourist, it's not really the thing for you. But now with ETFs, where security is slightly less of a concern, there is, I think, interest. And again, there are opportunities and there are risks, and of course, private markets that that was mentioned before. So I just wanted to talk a little bit about these things, challenges and opportunities. I guess we can talk about some of these things as well, and definitely they are there. And maybe I just can couch that in the sense of some of the things I've seen before as well. I'm trying to kind of keep track of time in case I exceed it. So I also want to leave some time for the Q&A later on. I'm sure there are a lot of questions that will come around. So I want to kind of start off with the great positive stuff about India in its cycle right now. So you've done your CFA, you will kind of know that we focus on some of these exporting countries that have made it rich, doing the Japan model, right? In the US and Euro, they're really the big exporters in technology. That's what we know, right? Industrial companies like China and Japan, made it rich by doing all the industrial exports. And Europe has always been in the luxury space, and many of the emerging markets have been in the commodity space. But interesting thing about India is obviously the export of labor. And that I think is very interesting because that labor may not has strong roots, has capital machinery, right, or capital. And that labor is also a forge of human talent that's flowing around the world. And one of the things that I've seen that allowed China to grow so fast was when the Chinese talent go overseas, they always come back. It's a kind of a boomerang. But the Indian talent, when they go out, they may not come back. And so that kind of helped this Chinese growth machine a lot. But times are changing. Okay, and we can talk a little bit about that later on. But you can see that there are, elements of this kind of capital flows that it definitely would be reflective of India's sustainability in that sphere. So if you look, and everyone knows this, that the remittances in the Indian market is huge and it's growing, and for all the great reasons that we have. My clients are also in the Middle East. I see the huge diaspora of the Indian community there and the huge amounts of wealth that's accumulated in that region. I've seen a lot of Indians in Singapore as well over the years. They are always in the highest areas and in the best professions. So that amount of wealth is just quite amazing. At the same time, you can see that the trade balance, the deficit has grown up, which is, for me, it's kind of a reflection of the strength of the economy. If you are, let's say, seeing this for the first time, a negative number for most people's, retail especially, is not a good thing. But in many economies where consumer is wealthy enough to actually import more than they export, it does reveal a source of strength. So if you think about this, the US is going to be looking very ugly in the deficit space. But still, the US is a pillar of strength, continuing. When I started off, the US trade deficit is the world's biggest problem, right? And it was many decades ago. It is still the world's biggest problem, and the US has not collapsed. So one of the things I usually kind of reflect upon myself is I went through so many cycles. And through those cycles, even after so many decades, the US lands up back on top. And I kind of think about what is it so special about the US economy that keeps it running, right? We all heard of the Japanese miracle and the Japanese disaster for 30 years. We hear about the East Asian tigers, Korea, Taiwan, Singapore, Hong Kong. Day in the sun was the 90s with the 1997 financial crisis, Asian financial crisis. They never were the economies that they were, right? And now we see China, the miracle, and now the question. And many of them are not sustainable in their growth trajectory, and they obviously went through a lot of disasters after that growth cycle. But the US is different. The US has come back, and again. The US has an ability to repair itself. It is the system. But the question right now is, it is going through a deep repair. repair that we've never seen before, right? So it makes economics and investment analysis a little bit more tricky because governments now is in the markets, right? And if you think about the China miracle was based on China being the most capitalistic country on earth. Although it's a communist country, but if you work in China, any business will flourish because you can do anything in China. This is kind of weird if you've been to China before. That's how they can move so fast. And it has capitalists or even more capitalists than the US. But in the last 3 to 4 years, China has become overly regulated, overly centralized, going back to, the communist roots. And the US, with the new administration, is deregulating. It's going to be painful. I've never seen this before done in the US, where there's a lot of chopping of the woods, and there's going to be a lot of disaster. There's going to be a lot of volatility. But there's a problem here because in the past, if you're a global investor, we were two engines of growth. The main engine was China, obviously. With China rising, the whole of the Asian complex will rise. So if the US didn't do well, who cares? Right? We got Asia, we got China, we got India. But now China is no longer there. So the only thing that's left is the US, obviously India, but India is not big enough to be on the books of everybody. And the capital account is not as convertible, so everyone pivots to the US. And you only got one engine of growth, so-called. And the engine of growth is only going to look after itself. Nothing for you, everything's for me. So that cycle is going to be very interesting. And I think the big fear is that almost every major market I see, most of them have an overweight position in the US, and that is a big risk. I go to Europe, they don't believe in their stock market, most of them are allocated to the US. Asia, a lot of them are moving the books to the US. I gave up on China, I'm putting everything in the US, right? I go to the Middle East, no, I'm going to put everything in the US. So every region is so the US is not, I think, big enough to absorb that kind of capital flows. The valuation is going to be a thing, and I think when you are trained with the CFA, I think you're in a better position than most people on the ground to be able to figure out, when will be the next blip, when would be a next valuation crisis. It always comes back to that, right? We think we're smart, but like one of my friends would say, well, Aaron, dumb people are born all the time. They are the ones that set up the next cycle. I say, oh, fine, that's good. So maybe that's an opportunity. That's what people like Warren Buffett will wait for, right? So these are, I think, interesting times, very different from the previous. The rest of the slides are just showing you I think the sustainability of growth in the investment management space is clearly something that's very sticky and likely to continue. Okay, maybe I give you some words that I remember the first day I joined PIMCO, what my boss was telling me. He said, Aaron, it's good you joined PIMCO. Then I was looking at him and he said, our business is the best business. And he went on and said, because our money is sticky, when they come, they never leave, right? Even if you kind of make mistakes along the way, the sticky money gives you the confidence, and you will make mistakes, trust me, you'll make plenty of mistakes. The question is what happens after you make the mistake, or what happens to you, right? And every mistake is always a great learning lesson. Obviously, and the view in that business, and I will maybe relay that advice to you, is if you are in a position in our industry that you take all the precautions, all the necessary fiduciary, responsibilities, your career is guaranteed more or less, because these kind of clients will always come back to you, right? You're almost like the family doctor to someone who needs the advice in that sense, and people do not, leave their family doctors. And the question is not to be able to be swayed by the quick money. The fast money is the one that has a lot of sways, but I was lucky to be the institutional front. The institutional front is plenty of sticky money, and you will find this out later on. Sticky money means it takes a long time to get his account. You take years, maybe even, of due diligence, 1 year, 2 years. But once it comes, it stays with you for usually at least 5 years, and hopefully for the rest of eternity. But retail, come in fast, leave fast, come in fast, leave fast, and it exaggerates the swing of the market. Some of you will be in the fast money business. Some of you will be in the sticky money business, right? And maybe there's going to be some things in between, but these are the things that you will probably learn how to handle and go through. Whatever it is, reputation is all we have. Track records, obviously, but reputation is more than important in our field. So I think the market is going to be sustainable. It's a question of whether you are practicing the trade in the correct way or not, right? You can be part of that, sustainability wave. So India has all the prerequisites. One of the biggest pension funds in the world, one of the biggest stock markets in the world, definitely one of the largest FX reserves in the world. So you got, just before we go in, and so you got everything that is needed in terms of size, variety, different aspects of that. And the thing is, I think the regulations here is very good. Maybe a little bit, maybe more protective than other countries, and maybe it's learning, and I'm looking at what's happening in Gift City, which is actually a very interesting development. What I'm trying to say is it does have all the necessary ingredients to really, be the next star in Asia. And the question is how to kind of look for gaps and how to look for, risk that will definitely come in every market. And so one of the risks, obviously, amongst other risks, is what we are facing right now, and I like to call it the 3Ds. And then people have been carried away with the huge growth after COVID. There's a sense of optimism after the huge pessimism, and for good reason too. But I think we can't lose sight of the overall trend. And the overall trend is this. I was lucky enough to be in the market in a period of globalization. Globalization to me means free trade, free capital, and free labor. From the 1980s till maybe about 2020, literally, you could almost, you're spot rotten, right? You could actually migrate to any country you want. You could set up a bank account in any country you want, and you could export to any country you want. Like technology allowed that. And because of that, you have this huge wave of capital and efficiency allocation, and the whole world grew. It was easy growth. And on top of that, you got free money, especially after 2008, the GFC, where almost every central bank was printing. Everyone was printing. Even if you're not, you are printing. So you got, they essentially killed the bond market, in my view, right? So that they could sustain, the equity markets and the real estate market and even the private markets. But how sustainable are these? Now, bond markets are back to where they should be, right? Which means that these markets will have to struggle to justify their allocation. But these kind of readjustments in markets can be quite painful for many. And so we have to be aware of this, because I'm not sure if the rest of the world has fully adjusted. As there was a shock, therapy treatment. So when you see the 3Ds here, which I think is going to be the future of the world, at least for the next couple of cycles, it's the vengeance against globalization, it's deglobalization. And on top of that, we have things like de-risking, decoupling, deleveraging, interest rates are going up, and deglobalization, I think, has interesting ramifications over the long run. It's not going to be immediate, because these election cycles, these new policies, it takes time to hit the real economy. And, the financial economy may not adjust as quickly. But what it is probably, the deglobalization means what? Well, capital is going to be very restricted, right? You got the sanctions, you got all these other, difficulties in moving bank accounts or setting up bank accounts. It used to take half an hour. Now it takes 3 months sometimes to set up a bank account. And sometimes if you send money, the other banks, it rejects. And you say, well, I'm giving you money, why are you not wanting my money? It gets to that extent. And I see a lot with the clients, okay? They're all red flags for banks everywhere, right? And you do not know why your money was rejected coming in. So money control is, money is no longer free. Trade is no longer free, and we are not seeing the end of the tariff wars yet. It's going to pick up steam. And labor. H-1B visa in the US, you say goodbye, right? Everything in Europe, that visa, even tourist visas are now getting a little bit harder to get. I'm sure you noticed that. So if you have the world of deglobalization, what's going to happen? Essentially, it's going to raise the cost of doing anything, which means inflation may not likely go back to where we were so comfortable with, during globalization. It was like 1% to 2%, right? I think it will struggle. So which means the Fed and Jerome Powell was actually good to say, just take a while, don't get carried away. And the good thing was when he said about 2 to 3 days ago, right? People kind of thought it, but he actually said it. Don't expect the rate cuts that you expected. But the markets did not dip that much because the markets were expecting it. So the market's going through these kind of discovery. And I think Trump 2.0 is so different from Trump 1.0 because he's got an advisor who is kind of unpredictable, right? And even if you are Google or Microsoft or Apple, anything that's in competition with Tesla and Grok and SpaceX, you scratch your head, right? So, but certainly if you're Panama, you be, kind of wetting your pants in so many ways. So, is he your friend? Is he not a friend? So it'd be interesting if you could ask, Prime Minister Modi when he comes back, and is he back already, from his, romance with Mr. Trump, and he might give you some ideas. Certainly this guy is a president that we've never seen before. He splits the vote like I've never seen before, but he becomes a very difficult person to predict. So, but then the problem is in normal times, you will not invest in the US. But the question right now is that where else can you invest if you don't invest in the US? It's more of a push factor than a pull factor. Everything else looks quite horrible. Europe is not likely to get back anytime soon. Europe and China is a value play. The only reason why you want to go in is because it's cheap, right? And Europe is so far behind in technology. The CAPEX has been totally forgotten for the last 10 years. They're way behind. And so Europe, I love to invest in Europe. I'm trying to find a reason how to invest, and I couldn't find it. The only thing is value, right? They're so behind, and it's going to be difficult for them because they're going to ramp up, spending for defense from 1% to maybe 3 to 4%, because when Trump is over, they have to kind of put it up to 4%, right? Because, the guy next door is not going to let up. And then they are way behind on the CAPEX spending. They have not done any CAPEX for the last 4 to 5 years. If you look at Mario Draghi's paper, it's a wake-up call to Europe. Hey, wake up. You guys are now way behind the US, way behind China. You're just way behind. And so they can't smell the growth. So I got not much reason to kind of put it other than the defensive diversification play. That's it. Right? And China, who knows where this decline is going to stop? We just don't know. India, we love to do it, but it's hard to get in. It's not as big, and it's hard to get in. Fundamentals are there. Japan maybe is a bit slow, but where else can you put in, right? Emerging markets is a mixed bag, totally, right? Totally mixed bag. There's a lot of defaults and there's a lot of some bright spots, but on the whole, no one is as optimistic on emerging as they were maybe 20 years ago. So these are the headwinds, right? But the good thing about India is insular. India is its own boss. India is different. And it's up to you to manage your destiny. If you're in China, your destiny is not in your hands. China is with your trading partners. That's a big thing, right? So I think that's the unique thing about the Indian cycle. And the other thing is, if I was a global investor, I got to figure out a way how to kind of position India in the scheme of things. And India, I think, has a couple of very good features. If I were to look at just the last 10 years, for example, I know you say last 10 years India had a renaissance in the markets, but let's say this is likely to continue. I know the valuations are a bit high. Hopefully the earnings will justify those things. But if I just look at the last 10 years in terms of what they will teach you in the CFA, risk-return space, India has an interesting role to play. If you look at India, where we have on this screen here, and its return is actually pretty good, and this is in US dollars. It's been converted in USD, and in the vol space, right? It certainly dominates quite a bit of these other alternatives, but Asia is on its own. US is on its own, right? But again, you're not competing against the US. You're trying to make US a lot more pretty than it already is, right? So there's some scope for India, and one of the things is that there is growth alpha, because look at India's alpha against the world, there is some alpha there. But the key thing is also, one of the key things is the lack of correlation, somewhat, in the equity markets of India compared with many of them, because India is in the 60s, rather in the correlation. The rest of them are mostly in the 80s. You don't look at China, because China is definitely the ultimate diversifier, because Chinese cycles are completely counter to the US cycle. But the China does not have growth alpha, right? So India does have some. So I think that is where the position of India. The reason why I say this is because we've done quite a bit of work with the Gulf, Abu Dhabi and Dubai. And the Gulf area, they are trying to make, obviously, Dubai, Abu Dhabi, and Riyadh an attractive destination for funds. And they say, how do we kind of make this? How do we sell our funds to rest of Asia? Because there's huge pools of fund in Asia. So we try to figure out where the attractiveness of the GCC, how they will fit in an Asian portfolio. Because that way you can not just sell to institutions, but also in the private banking front. It may not stop short of the retail, but there's enough money in the institutions and the family offices and the super high net worth to be able to make a difference in the allocation. So these are the things, and I think India has, definitely, for example, I got a couple of clients, I want to kind of put them in the India allocation, but we as external money, we want to get as many opportunities, selection as we can. We're not finding enough, right? So I think there is scope at this point. Let's see, can I move this up? Right, so I'm going to now quickly talk about the huge elephant in the room. Maybe you guys are probably AI experts, I don't mean to do it, but maybe I'll just give you some thoughts, because that's clearly the elephant in the room. It's changing the way we do things. It's changing how you learn, how we interact, and how the market works. If you go to JP, JP is one of the key movers in this space. Morgan as well, Goldman has always been, Bridgewater, BlackRock. So JP has a total, total dedicated site to AI. So I think what's happening is the sell-side banks are creating these AI models that the buy side can use. So I don't have to create my own models, yeah? It's like what they've always done in the generic space, right? You use the sell side to help you with some of the things that you need to do. Obviously, you do it yourself, but the sell side sometimes have more budget than you will have, and that helps you as well. So JP Morgan side is getting more interesting, where you can actually use some of the tools, put in your data, and run things. Bloomberg is getting interesting too, but Bloomberg is getting expensive. And they're going to release this GPT, Bloomberg GPT. And it's already released for Bloomberg's close friends, right? Bloomberg does their technology in a very interesting way. But anyway, the GPT, they're trained on about over 700 billion tokens, which is a lot. In the financial area, they are probably the most, they could be the best LLM model or GPT model that we see, okay? Because most of their training, half of the training is using public data, 350 billion tokens. Chat 3.5 also uses less than 1 trillion tokens, but 4.0 probably uses anywhere from 1 to 10 trillion tokens to train. But what's interesting about Bloomberg GPT is that the other half is trained on private data. And so if you get them to kind of do analysis around, stock filings, they're very fast because they have all the information. And you probably know that in terms of financial data, Bloomberg has the most. No one can compete with Bloomberg in the amount of financial data they have on all markets. So they're going to maximize this, but it means that they can monetize it as well, right? So we look at using Python, using their neural networks. I mean, it can cost you upwards of $100,000 to $400,000 just to have an account. So you can see how expensive that is. But the thing is that you don't have to draw data from somewhere else because the internal data they have at storage. So it's something that is, I think, is going to change the way we do research, the way we kind of do analysis and read the news. Then I kind of want to round out the AI space a little bit. And I like to look at AI in a way, in the architectural form, because I think we have to figure out where we're going to play. Because DeepSeek tells us it's interesting to play at different levels, right? You're not going to be at the level of OpenAI because that's going to cost you $10 billion a year to run, right? OpenAI, operating budget is $10 billion a year, and the revenues is $3 billion, which means that they lose $7 billion a year. And no company can really do that, right? Except if you are everyone's favorite child. But if you look at how blockchain kind of separates the players, blockchain has level 1, which is the blockchain itself. It's probably not wise to do level 1 business because it's going to be a lot of money, right? It might be better for you to be level 2 or level 3. Level 2 or level 3 are the scalers and the applications. Application is where you monetize. Level 1 is very hard to monetize, and you spend lots of money, and it's usually open source, right? So it's up to you whether you be level 2. You're level 2, you provide the plumbing, hyperscalers. Companies might need you to make it more efficient, the cost of transactions lower, speed of transactions higher, and then level 3 is the actual business, right? So everyone monetize it easier, level 3, okay? And that's how the blockchain fraternity likes to think about the ecosystem and the architecture. I kind of like to think about LLM in a very similar way. So level 1 are really the underlying token trainers. I mean, no one has the capacity to train 10 trillion tokens. You can't afford to buy 50,000 H1 GPUs. Right? No, how many people can do that, right? And there's only a couple of people that can. And these are the level 1 players, okay? And they may not be able to monetize because all of the output that you have are all these trained tokens, right? You have, let's say, a 10,000 element vector, and you got, 50,000 of these tokens. And then you retrain those tokens and transform them. And so you could be a level 2, which is the middleware, and you kind of make it easier for people to train. you do fine-tuning of your systems, you even provide AI agents, right? So you can play different levels. But level 3 is where I think the interesting thing is, where it's the applications, the monetization is much faster, and your spend is going to be less. You're not going to have a capex that's going to be more than $1 billion, right? And you are just using, and you could be an agent yourself. You can be an AI agent, which is going to be the big thing this year, right? So then you figure out, okay, if I'm going to do investments, I'm going to be a robo-advisor. If I'm going to do AI research, if I'm going to do client management, if I'm going to do risk management, right? I'm not going to start a new LLM myself, right? I'm going to figure out how am I going to overlay my model on either OpenAI or Claude or Perplexity or Llama, and which is the cheapest way. And the AI agents allow you to do it very well. So I'm sure many of you have done the agent from OpenAI, and they kind of break new grounds. And these are the things I think that just maybe democratizes AI to the extent that the way I think the decentralized ledger has helped to decentralize monetary exchange. The problems is there. I mean, many of you have seen how you get the wrong answers. But one of the things that I think for us is going to be important for AI is that the systemic risk we still do not know yet. And so, for example, if I am going to be a single AI node, if there's only going to be ChatGPT and nobody else that's playing the investment game, what he is going to be doing, he's going to be a price taker, and he's going to be diversifiable, which I don't need to worry about him causing global chaos. The problem I'm worried about is that I have multiple AI nodes. I got all the different agents, all the different DeepSeek and ChatGPT and Claude and Perplexity and everything that's trained using the same data, which means that I'm sure the models are the same, or not that different. The transformation is about the same because they learn the same thing. And all of them is open source, which means that how different can your model be? It's just either faster or slower, more efficient or less efficient, but it's going to land in the same place, almost. So that's a worrying part. If every AI out there is going to have the same outcome, the same view, the same decision, it becomes a systemic risk. You got no diversifiability in that situation. And we know that AI is really good in knowing things in the past. You can't beat it, but it is really horrible in trying to figure out what's going to be in the future because it's never seen it, right? It can't predict anything that's never seen before. So if you ask AI, any of these AI things, what's their outcome for, for example, the Ukraine war? Well, we've never seen an episode on the Russian-Ukraine conflict in the past, so there's no outcome to kind of base it on, right? And so you can see all these issues. The decline of China, never seen that before. I can't tell you, right? And so on. And someone like President Trump doing all the things he does, they can't figure out because they've never seen it before. So in terms of what it can do, what it can't do, if everyone sees, the same data, everyone has the same algo, and the algos are open source, you're likely to come with the same outcome, and which is maybe you will have some of these episodes. So this episode is actually quite famous. I'm not sure whether you know about this. And this is actually on the radar screen of a lot of regulators. So there was a sell-off in August the 5th, 2024 in the US-Japan market. And the deep suspicion of these regulators is that it was triggered by a lot of AI trades because they're all moving in the same direction, triggered by the same indicators, right? And they're all coming from AI nodes. And they're very fast. You can always smell it's an AI trail. And so they're figuring out, because there was nothing fundamentally wrong with the markets, but suddenly the markets just, went on this tangent, and this is it. So future skills, I'm going to skip right through it because I think we covered it with all the great CFA volunteers here. I'll just give you my experience. Maybe that will help you. I was kind of a reluctant CFA exam taker, really, to be honest. I did it because my best friend pestered me to do it with him because he needs a study pal. So I said, okay. And so I studied with him. So I never looked back ever since. And it was the best thing I ever did. So I would, if you're thinking about, continuing, fantastic. It's a great thing. If you are going to be in this field, this is probably the greatest ecosystem that you can have. So I went through this journey here. I was with the Singapore Society. I was also with the Asia Pacific Advocacy Council in different periods, Capital Markets Council in different periods. And interesting is Capital Markets Council occurred during the GFC. So one of the things is that Capital Markets Council, we created a commission, which was at that time initially chaired by Paul Volcker, which resulted in a commission that supported President Obama in what to do. So it eventually resulted in the Dodd-Frank Act. So you can see the impact that you make in a body like this, because you are independent, you do not have a book to sell, you don't have a client to protect. You're basically working for the good of society and the good of the industry. And obviously that went up to the Board of Governors, and there was an interesting experience. We set up also the ARX, which some of you hopefully has the ability to participate. This is when I think Paul was the CEO, and I was the chair. And so we said, we're going to do something for Asia, because many of us felt, CFA is mostly a North American thing. So we say, let's do something for Asia that is going to be plugging the holes where, I think this is something for Asia by Asians, for our markets. And now I'm with the Research Foundation. I stepped down as chair last year. Last year. So I'm now the vice chair. But I'd like to kind of talk a little bit about some of these things, because I think it might help some of you. So especially in our field, with the rise of AI, it doesn't mean that you don't have to read research, because AI is going to read for you. But I think it has to be the result that you can read more research. Not that you shouldn't and rely on AI all the time, that you are more encompassing in your your consumption stream. So CFA has a lot of these support functions, right? One of them is the Research Foundation that we do, and one of the things, the recent things that we did, which was actually, I think, pretty well received, is a handbook of AI applications in data in investments. Okay, we did it because we thought there was a need for it. It came out about 1.5 years ago. It was written by people who are practicing in the field, from Goldman, from Mann, from Neuberger Berman, and a couple of other NVIDIA as well. All the experiences that they have and all the things that they have in their own experience. And I think that's helpful. Another one that was did, and you might know that there is a Research and Policy Center that was created by Mark Franklin at the CFA, and that was doing actually pretty good research. And this one just came out was written by Rodri, and I kind of really was happy that they did it. And this is from the Research Policy Center, because I'm not sure whether you read it. It's actually pretty good. This is about valuing crypto assets. In the past, nobody knows how to value crypto assets, right? It's just like, I buy if it goes up, I sell if it goes down, but there is no valuation model. How would you value a crypto asset? And what this does is they went through and understand the different types of crypto assets there are, whether it's going to be a token, whether it's going to be a DeFi, whether it's going to be a network, what is it, and value it either from a discounted cash flow or a total addressable market approach or a network approach. Several approaches actually is good. So with this, I can actually go to an institution, a pension fund, and say, okay, remember you didn't want to invest in crypto assets because there is no fundamentals. Now we have an ability for you to value something. It may not be the best or it may not be the final one, but it is a start. Because the evolution of DCF right now, as you know it, is evolution through tons of decades of work by many, many bright people, right? And that's the evolution. So, I think the CFA wants to do independent research, There's a lot of good research that's been done by the sell side. Amazing. Buy side, they don't come up with too much. But CFA, I think, goes another level up. And sometimes they will come out with, really good ones. And I think I will encourage you to kind of go. And finally, the FHA. This is what every practicing investment professional should read. It's readable. It's not like a journal form. It really is meant to be a practitioner, serious, journal. So these are, and it's celebrating its 80 years. So it's been around for a long, long time. It's a great history. So these are really supporting things, I think, of the CFA that you can actually, try to use your members or hopefully members. And the network is going to be amazing, right? Because the fact that I'm here, I've gone to most of Europe and the US. I met, a couple of, I guess, politicians along the way, who wants to kind of, the variety of network is just, I think, is excellent and amazing. And I think for you, it's also good to have an idea of, meeting how people do things outside. The thing about India and China is great is they're big countries, right, basically. But it's always good to kind of take reference from outside the region. Even I think Europe has a lot of things to give. You may not think that that's going to be an attractive asset class but the guys that are very professional, they are very good. And it's always good to kind of get pieces of, advice and cross-reference from them. So just try to keep ahead of the technology, the skill sets, be true to, but I think one of the key things is be true to the nature of your job. I mean, for us, reputation is everything. Okay, you have to be a professional, but your clients must be able to trust you. And reputation will last your lifetime. Education, it's continual. You can't, because if you kind of hibernate in the next 5 years, you come back, things will have moved a lot, right? It's a continuous stream. But reputation is an asset that you build along the way, and that will going to last you for a foreseeable future. And I think in our profession, it's almost everything. And the market right now, it's such a small world that you need to establish your own ecosystem. Okay, so the final thoughts. You are your best investment, really, right? So I'm going to stop here and just hand the floor to Rajni if there are any questions. Thank you.
Thank you, Dr. Allen, for quite an interesting presentation. So my first question is towards the theme. You mentioned about the global careers of, looking at the trends across the globe and probably picking up some insights from there. So there were two key things which were coming out of your presentations: the headwinds in the form of de-risking, deleveraging, and deglobalization. Second, that money going to US is more of a push factor than a pull factor. Now, somebody who's starting out their career or in the initial part of their career, how can they sort of, figure out about the opportunities which could emerge from these trends, and then they could capitalize on those?
Yeah, okay, thank you. I think the easier answer to this is it's a good thing for India because India is America's friend. But again, you want to look for more sustainable features than that. The other thing that I think works for India is not as internationally plugged in like the rest of the Asian complex because of the export machinery. India has its own pathway, so it's more insulated in these global winds of change because it doesn't depend so much on FDI, it doesn't depend on your export machinery. Yes, a tariff is going to hit India, but that's a smaller component of some of the other things. I guess the overseas repatriation of money, that's going to be maybe impacted, but in most of these cases, they are mostly documented stuff. So I don't think that's going to be a huge impact. So I think if you consider the rest of Asia, India is most likely to be the least affected by some of the things that we see coming out of the US and Europe. But how can India kind of maximize this? I think the time for India is long overdue, right? India's, place in the world, having this non-aligned situation is really great. But the world is coming to a situation that you have to take sides. Unfortunately, that's the way it is. The nature of the beast is such that you have to choose one side or another side. If you're not, then if no side wants to take you, then you get into this twilight zone where you just kind of slumber on, right? So again, I think India is open to either side, and that's good. But the question is, how would that game turn out? I think India's great situation is the human talent, obviously, which this is all about, and India has great education, great infrastructure in the schooling system, in the employment situation as well. So I think India is well positioned in the knowledge revolution of especially applications for financial markets to be able to do this. So I think there's definitely a huge role to play. India financial markets, I think, is interesting in terms of its, like I was talking about, the correlation with the rest of the Asian complex. I think there's more appetite for Indian assets in the Asian complex than in maybe the developed market complex, because you have to understand how institutions allocate money. So institutions like to allocate money according to developed markets. Most of it is allocated there, and maybe 5 to 10% to emerging markets. They are very formal in the way they allocate stuff because it's all driven by process. And so they say, I'm going to put, like, say, 80% in developed markets, 20% in emerging markets. And in emerging markets, it's got to be spread out. They do not go for a singular country. And then you figure out how much India is in the MSCI EM space. And then that's how much allocation you might get, right? And that's how many of these global market flows. But now with the decline of China's allocation in the MSCI EF has gone down. I think India's gone up. So, and there's a bit of a reversal. At the same time, you also want to look at the beta play. So the beta play, like I say, 10 to 15% emerging maybe at best. If emerging makes a run, they might increase it from 10 to 20. I suddenly see 25. I mean, it's a very small component. So those are the little, positives. But I think you still need to have a lot of internal growth. I think there's going to be a lot of internal growth. I think the growth of the pension plans, the retail wealth, these are things that I think is going to be holding you in better stead.
So there is one related question from audience on this theme. So the question is that due to impact of UK recession, do you think that London's Lombard Street will shift to Singapore now?
Sorry, can you say that again?
Do you think that because of recession in UK, London's Lombard Street will shift to Singapore? Will the epicenter of financial industry will shift to Singapore from London? That's the questions from the audience.
Yeah, okay, yeah, that's an interesting question. I've not heard that question before. I've heard whether it will shift from London to Berlin or Frankfurt. To Singapore, I think it's interesting to ask that because we do see some shift of Swiss assets to Singapore. The thing is that Singapore's financial strategy was actually quite interesting. In the year 1999 or 1998, GIC started outsourcing their reserves to be managed by global investment companies. They pulled them in. GIC in that time had 300 over billion, which is quite sizable. I was in a company called Rosenberg, and we were in San Francisco. We're the biggest technology investors there were. So we take about, I think, 20% everything that's going to be, IPO'd on the NASDAQ. And that was during the crazy days of the .com. And so GIC gave us a sizable amount, a couple of $1 billion to manage there. And then they also gave money to things like capital, PIMCO, all the big players. So they suck in the huge boys and the little boys will follow. It also grew the local industry because they were helping the sovereigns manage some of their sovereign wealth funds. And shortly after that, 3 years later, they created something called the Wealth Management Institute, which was going to be trying to make Singapore the Switzerland of Asia, because they thought, well, Asia's wealth is going to grow. They need a independent, country to be able to store their wealth, and they started that. We didn't know it'd be so successful, and so I think the winds of change allow us to kind of position ourselves in that area. So I think, and I think we were so successful that I think the Swiss were surprised. So, so it is what it is. And but to hear of London going to Singapore, maybe there will be some. I don't think that's going to be, because London still retains a lot of attraction, has a global center of finance. And the democracy system in London, and so on and so forth. The British pound, it's not as tightly governed like the Singapore dollar. And I don't think, I think the Europeans stand in many ways in a higher position than Singapore. Singapore is mostly maybe some of the centers of gravity of Asia. With the decline of Hong Kong, Singapore has now gotten a lot. So we did, I think, have a lot of flows from Hong Kong, that's for sure.
Yeah, so the takeaway is that probably Singapore will expand, but not necessarily that at the cost of London shifting there, it will have its own expansion.
Yes, yeah. I would think
so.
Well, you like Dyson? I mean, okay, he's as London as, I guess, UK as he get. Yeah. He did shift his family office there. He's put his assets there. He's incorporated some of the stuff there as well. There's some. But I think most of the people who actually do London is because there's a center of financial flows. And Singapore has some, but Singapore's really good flow is in the FX market. It's not in the stock market, it's not in the bond market, it's in the FX market. And London is actually is a huge liquidity center for many of the asset classes, equities, bonds, and FX.
So now I'll move my question to the soft skill side. So, you have seen your career across the various countries, if I may use the word to say, the global career. Now, somebody who is aspiring to have a global career, what sort of skill set they should be focusing on? Because you end up working in multiple countries, multiple cultures, and a lot of things come into picture, when you maneuver yourself. So, some learnings which you would want to share with us.
I think you are in great shape because all the universities here are taught in English, right? So English is the major hurdle, right? And you guys, in a great position. Used to be that people would just attend a UK or US university, come out and hope to be recruited, because that the system in the US works differently from rest of Asia. So if you're undergrad, you get out, you might work in an investment firm, but only for 2 years. You will, after you're asked to leave, then you do an MBA, then you come back and try to get in again, right? They're not going to give you that position, permanent position, without an MBA. That's why the MBA schools are so popular in the US. That was the traditional route that people use to go into the investment management industry, whether it's an investment bank or whether it's going to be an asset management firm. But nowadays, I think because of this slowdown in MBA recruitment, I think the avenues are more now. Maybe Europe would be an easier place to go in, then you go to the US, because the US is a bit tough on the H-1B visa right now. I've got a lot of friends who left the US because they could not get the visa after about several tries. Then they moved to London, Goldman Sachs, just a couple of people. And like, for example, Goldman's a great supporter of their global franchise. So you could be employed by New York, and then you'd be working in London because, let's wait after the Trump administration goes away. Maybe in just another 4 years. Maybe you never know what happens. But I think everything is in flux. I think the other area of getting in, do not be fixated with going to a big firm, because big firms don't recruit that much. Because asset management industry is a very scalable game. right? When I was at PIMCO, we're managing about $1 trillion over. We only have 32 fund managers, not that many, right? And maybe 40 analysts, not that many. For a company that manages the most in bonds globally, that's not a lot. When they recruit, they don't recruit a lot too, and they don't train a lot. So your ports of entry can be in, investment firms or boutique funds or family offices, those kind of things. And then you move out. You can be a trader, in a smaller hedge fund and make your reputation from that as well. I think the great thing about the investment industry is they speak to different character sets. Research analysts, and basically you're not really so much a decision taker. You're a great analyzer. You can kind of connect the dots in many ways. A trader strength is he takes risks all the time. He's the best risk taker ever. But a portfolio manager is an aggregator of things. He must be able to connect the research to the appetite for risk and do it in multiple ways, not a singular asset. Because a trader is very good if he focuses on a singular stock or singular bond, and he trades that, because that's what he does. He looks at the patterns and he goes in where liquidity is and where liquidity doesn't help. An analyst looks at things in one sector. The strategist looks at multiple sectors, right? But the portfolio manager is where everything comes together, whether he accepts the recommendations of the analyst and the strategist, and be able to direct the risk appetite to the trader to do the execution, right? So the great thing is that not everyone is meant to be a risk taker. Not everyone is meant to be a research person. Not everyone is meant to be an aggregator to make the decision. And so there's a spot for a lot of people, depending on your, inclination, and you work on that. And the difference there is also in the US, you can be an analyst for your entire life, which is I've seen people who are in their 50s or 60s, they're managing director, and they are analysts true and true. In Asia, it's different. By the time you got into 4th or 5th year, you don't want to be an analyst anymore. You want to be a portfolio manager. You want to be a junior portfolio manager, because that's where your glory is. And in the US, it's such a research culture that I've seen many analysts who are more successful than portfolio managers. They make more in bonus. They have more power. So it's not the name, right? It's the nature of your shop. And in the US, they respect research a lot. That's where the ideas come from. Not where necessarily the calls, but the calls are the ones that execute the ideas. But they need at first to have the idea pop up and to be able someone to make that call. Like for example, DeepSeek. Everyone looks at DeepSeek, but I struggle to find a company that gives me a good evaluation of DeepSeek. So you have people who say, well, DeepSeek it changes the whole game of resource allocation. The other one, it says DeepSeek copies everything from ChatGPT. And many of them don't go deep enough to give me an indication to support what they are saying. Because for me, I say, should I short NVIDIA or not? Huh? Should I kind of get out of the stocks ETF? Should I abandon the semicon game? You don't have enough people that goes deep enough to give you, they're just doing research at a high level, and they are very polite because you don't want to say something that may antagonize the Chinese government or something that will antagonize NVIDIA. And so, that kind of situation is, I think, interesting as well. And I remember quite clearly that during my tenure on the board, there's this guy called Mike Mayo. I'm not sure if you know Mike Mayo. Yeah, he was during the 2008 period, 2008 period, he became very famous because there's something called Occupy Wall Street. He was out there protesting against the banks, some of the so-called conflicts of interest and stuff like that. He was sacked by many banks. We followed her career, and we nominated, during my term at least, we nominated him to an award for speaking out. And I think that's what one of the mission of the CFA is for. Even though it might affect your career, but you are I guess you are independent. He spoke up against some of the banks that had bad practices, and he was prosecuted for it. And I think I was glad to be on my tenure to have the board that supported the decision to nominate him to win the prize. Because I was saying, now, this is the man who sacrificed his career and his family to do the things that we say you should do. And we as board members, because many of them, I guess, are also hesitant to make that big call because you might antagonize the employers. Well, this is a guy who is willing to give up his career to do what we believe in. And we as a board, the smallest thing we can ever do is to recognize him for it, right? So, and I think these are the moments that you really make you appreciate the company that you're with. To really, just walk the walk and just not talk the talk, which is, I think, important for the industry to have a sanity check, because greed always gets in the way, and money gets in the way, and sometimes we lose direction. But with fundamentals, with a sense of purpose, and with the value statements, I think that's the way to kind of make it sustainable, because or else you get into these cycles that goes in and out, and it destroys careers, and I think we don't want to be part of that revolution.
Right. So we have a lot of questions pouring in, but due to paucity of time, my one quick last question to you. So you have, pivoted your careers into different asset class, be it asset allocation, which is more of a across asset classes, then equities to bonds to now a technology and investment industry. So a quick takeaway on that, how to sort of maneuver when you are moving from one asset class to another asset class.
Yeah, thank you. Okay, so I'm a bit of an outlier because I always want to do things that were interesting. So if you're looking back, if I do things for the money, I would have chosen a different path. But I wanted something that will keep me awake, that kind of thing. So I started in I would say I started in the quant space. Then I moved into equity research. Then I managed bonds. And then from bonds, I did asset allocation, all assets. Then I moved into hedge funds. And now I'm trying to use tech to wrap everything around. So the things I've learned is I think investment is very interesting because I think, there are many religions, like life or pie. Which church should I go to? Which temple should I go? You go to every house, everyone has their own religion, right? The quants and the actives, they don't speak to each other because one speak Greek and the other speak, plain business school jargon, right? The equity guys and the bond guys, they don't speak to each other because they use different models, right? The derivatives and normal assets don't talk to each other because they think in very different ways. So you can all clash of cultures, clash of the beliefs. Mm-hmm. And even within, let's say, a bond house like PIMCO, the way they do things against, let's say, another bond house, the way WAMCO or other things, is going to be quite different too, the culture. So I think that's where the opportunity is as well. But my thing is, I wanted to experience some of these cultures, and they are so different. And I try to get something positive out of that and to understand why the market is where the market is. So my takeaway is you can find a shop or that can offer you that learning platform. If it's a good fit, fantastic. If it's not a fit, then sometimes you have to figure out maybe trying to understand the other side. Because I evolved quite a fair bit. I came from the quant. I was trained as an engineer and a physicist. So for my side of the picture, my lens was everything was very structured, very framework, very everything. But I went to work in some of the firms like Rosenberg. When you're investing in .com and technology and all that kind of stuff. These are growth areas. There's no data. Everything is new. Everything is, you have to scenarize everything. These are things that quant will never help you. Quants are going to help you a lot in value investing. That's the only thing that quant is really good for. Matured value, even fixed income industries, quant is good. But for equity and growth and these green sectors, quant doesn't really work. And you get to appreciate how great those guys are, right? These equity guys, active guys, don't know much quant. But they're very smart in what they do, and they will always beat you to it because you're using a set of tools that's not meant for them, not meant for this industry. And same thing for fixed income. If you're doing government bonds versus IG versus high yield, right? Never use quant for high yield, case of death, right? And you don't do active for treasuries, again, case of death, right? I mean, so you have to know what kind of methods to use, what kind of tools to use, what kind of people to talk to, and I think that's going to be, I think one of the learning points I have. Be open to all the different practices because that's how we grow. And one of the things I learned also is to be always tolerant. So the Research Foundation, I shouldn't mention names, but when I went in, it's a very old, a very established, very, very well recognized, organization that does research. There's people there, the top in the field, Nobel Prize winners and that kind of thing, right? Very good. And I went in and I said, okay, should we be doing something on crypto assets and AI? And they look at me and say, no. And some of them would say, crypto, isn't that a Ponzi scheme? Then I say, well, they could be, but what do we know about this? And say, well, no, I'm not touch it. These things are not kosher. I say, how do you know it's not kosher? Have you done any research on it? No, I don't want to do it. But you see, the thing is that I think we owe it to our membership base to do the research and let them decide whether it is or not. Because I think we're too arrogant on our part. And even if you are close to winning a Nobel Prize, that your decision is everything. I think the great thing about our industries is able to assimilate different points of view, different models, different perspectives. And we are the aggregation of all those differences that gives us a point where we can believe that that is the sum of all our aspirations, our fears, and our beliefs. And I think we try to support those things, right? And I think what the CFA does, you have to kind of recognize that's how we grow also, right? And I think that's one of the things I've learned both from my career and from the days I've worked for the CFA, the volunteer work that we've done for CFA. And the other thing I want to also I find it very helpful for my career to kind of toggle both sides, because in your work you'll be fighting fires, right? You got no time. Very operational stuff. At the CFA you can sit back and think a little bit. You can mix with people who think like you. You're not fighting fires anymore, right? You're just looking at things from a 360 view, right? And you make those things help each other, because at work you got no time to think about the big picture, because you're the guy who is supposed to be handle that client in that market, on that trade, fighting that disaster. You just don't have time, right? So I think the CFA gives you an opportunity to be able to have a more complete appreciation of your job and what your job means, and upper level, lower level. So I thought that helped me quite a lot too.
So on that really high note, I'm sure audiences had a lot of. I'm sure they still do have questions. So Dr. Aaron would be available with us during the day, and because of paucity of time, we cannot ask further questions. So.
Thank you very much.
Thank you so much for sharing your insights with us today, Rajni and Aaron Loh. I'm sure our audiences have gained enough actionable tips to take their careers forward. I would like to invite Mr. Litesh Gada to come on stage and hand over a token of appreciation.